Tax loopholes revealed, strategies for everyday people. In this video, I'm going to give you 12 tax loopholes or strategies that many people overlook. Number one is health savings accounts. I absolutely love health savings accounts because your money goes into the health savings account pre-tax, and when you take it out, you can use it for lots of everyday health care, including copays, prescriptions, and now even over-the-counter medications and supplements. Number two, retirement, backdoor Roth IRA. Many advisors will tell you that you do not qualify for a Roth IRA because you make too much money. This is actually not the case. Virtually everyone can qualify for a Roth IRA, but what they do is you contribute the money to a traditional IRA, and then you do what's called a backdoor rollover to a Roth IRA. The great thing about Roth IRAs is that all of your earnings over the years are tax-free at retirement when you take them out. You pay the tax on the front end, and on the back end, you get the retirement money without any tax consequences. Number three, saver's credit. Low to moderate income workers can get a credit, not just a deduction, for retirement contributions. So don't forget that. Number four, education credits. There's the American Opportunity Credit and the Lifetime Learning Credit. They reduce your tax dollar for dollar. You just have to check to see if you qualify. Side hustle deductions. This comes up a lot. If you have a side job, so you have a full-time job and maybe you drive for Uber, you're going to want to make sure that you actually declare the income for your side gig. A lot of people don't, but you should. And then make sure that the expenses that you incurred in order to produce that income get deducted. A lot of times people don't, they just don't. And for example, in my Uber example here, you're going to want to make sure that you claim the income, like I said, but then you're going to want to claim the mileage because your car didn't drive itself for free. You had to pay for gas and whatnot. So make sure that you take the deductions for your side hustle. Number six, capital gains harvesting. If your taxable income is low enough, you may qualify for 0% capital gains. I even make this mistake. When I'm thinking about capital gains, long-term capital gains, I typically think of the rate of being 20%, but that's not necessarily the case. There is a bracket in the lower income that's 0%, then it goes to 15%, and relatively quickly it gets to 20%. But don't forget, you may have long-term capital gains that if your income is low enough, you won't owe any tax. You do have to report them, so don't forget to report them thinking, oh, it's zero taxable, so I don't have to report. No, that's not the case. You have to report it, and then you have to claim the 0% rate. Number seven, tax loss harvesting. Don't forget that you can sell losing investments to offset gains with a $3,000 deduction cap against ordinary income each year. So let's say you have a stock that's performing and you want to go ahead and cash out. If you had a $3,000 gain on that, but then you had a $3,000 loss on a dog that's just been in your portfolio for years and it's really not doing anything, you might want to go ahead and do that and capture that loss to offset the gain so you don't have to pay any extra tax. Number eight, 529 plan growth. What is a 529? A 529 is an educational account typically used for your children. Really great. They've been liberalized over the years. You contribute money much like an HSA, pre-tax, and the growth is not taxable as long as used for educational expenses. Nowadays, you can actually use it even for rent and room and board. That hasn't always been the case. Number nine, energy credits. Things like home solar panels, efficient appliances, and electrical vehicles often come with larger credits. I actually participated in this myself. I had a water heater that my insurance company made me replace, even though there was no problem with it. When it came time, I went ahead and replaced it with a hybrid water heater because by the time I did the math, the tax credit meant that the hybrid water heater, much more efficient than a traditional electric water heater, was actually not much more expensive if I took the tax credit. So I went ahead and did that. Number 10, the Augusta rule under Section 280 AG. You can actually rent your personal home to your business for up to 14 days a year, and that can generate tax-free rental income if structured properly. Number 11, dependent care credit. Covers a portion of daycare, babysitting, or after-school program costs while you work. This is going to be for the lower incomes. Standard deduction bunching, stacking charitable donations or deductible medical expenses into 1 year to exceed the standard deduction. So for example, maybe you've come into some cash and you want to give it to the church. It's late in the year and you look and you say, I know I'm going to have this large operation next year that's going to be deductible on my Schedule A. I think I'm going to go ahead and put off my charitable giving to the church in December and go ahead and do it in January. So those are 12 tax loopholes that I have now revealed that are strategies for everyday people. Hopefully one or more of these strategies was helpful to you. I appreciate you watching. Thank you.